Hi everyone, it's Arsh Ellahi, and in today's video we're going to be talking about something that lots of people talk about in the property industry, and that is, should I have my portfolio on a capital repayment basis or should I have all my mortgages on interest only? Now, first of all, I want to say a quick thank you and a quick hello to all new subscribers. If you're enjoying the videos, please press subscribe or press the notification bell somewhere along the bottom. Now, first thing I will say is that anything that I say in this video is not deemed as financial advice and is literally my opinion on what I've done that has made me succeed in my property journey. If you like the thoughts of this video, please take some formal advice from an IFA independent financial advisor. Now, I meet lots of property investors up and down the country who literally looking to get involved in property, and I appreciate that everyone is at a different journey or a different part of their journey. So some may be just starting out, some may be that have already got a small portfolio that are looking to grow that portfolio, and then finally you've got the seasoned investors that have got portfolios now, they've done the residential, they're now potentially looking at commercial or also development deals. So that's the kind of transition that you go through as a property investor. You start off small by buying your standard terrace houses, then potentially go to your HMOs. From your HMOs you then start looking at potentially slightly larger HMOs, development deals, and then also larger commercial deals. So that's the kind of transition. So, but the key to it is how do you fund it, and more importantly, how do you structure it? Because for those that don't know, I'll go through the basic terminology. With an interest-only mortgage, you're only actually paying the interest on the loan. You're not actually paying down any of the debt. So let's just imagine that you bought a house for £100,000 in 2020 and you've got a 25-year mortgage product. At the end of that 25-year mortgage product, so come 2045, the debt level would have remained the same. So if you purchase the property at 100,000, they've lent you approximately 75% of that, which means that you've got a loan of 75,000 on it. Come 2045, the loan amount is still going to remain 75,000. Now, that's great because hopefully over that 25-year period, you would have hopefully appreciated in capital growth. Does that? I'm hoping that you're still with me here. So it would have appreciated capital growth, but more importantly, as a result of keeping your payments on interest only, your mortgage payments would have been slightly lower than it would have been from capital repayment. Therefore, you're making more on cash flow. And this is the way that lots of property investors get started, because they need the cash flow in order for them to build up another pot of cash to buy the next property, buy the next property, and buy the next property. Now, there's nothing wrong with that. Now, I've done a little chart. And apologies, first of all, for the hand drawings, and hopefully you're going to see that. Now, on the interest-only model here, you're going to see that the interest level, or should I say the debt level, remains the same. So you can see we've got debt level and we've got time frame there. So the debt level remains the same on the interest-only model. However, over the 25-year period, we are going to see fluctuations in the property market. That goes without saying. And we're going to see highs and lows, and it's all dependent on where we end up. At the end of the 25-year period, what happens if we end up here? Or what happens if we end up here? Now, if we end up at, we get peaks and troughs in the property market, as you've probably seen. As we're recording this, we're literally in lockdown, and as a result of being locked down, we're facing going into recession. As a result of the recession, there's talks of property prices dropping circa 20-30%. I've done lots of videos on this, so please feel free to watch some of the other videos that I've done this. I've called it the UK property market lockdown. So going back to my chart, what happens at the end of 25 years? You don't know whether we're going to be in a recession or whether we're going to be in a boom. So therefore, if we're in a boom, yes, great, your property values have increased, fantastic. But what happens if you're in a recession and your market value, which you see, let's just say that you bought it for 100,000 in 2020, now, fast forward to 2025, we'd like to think that the property has gone up in value because that's what we're all doing it for. We're looking to make cash flow, but also capital growth. However, what happens in 25 years that we're in recession and that property is now still only worth circa 100, maybe even £90,000. Yes, you made cash flow, but there's no capital growth. What do you do at the end of that term? Do you try and sell the property? And if so, have you got equity? Or do you just now renew? Now, Like I said, there's no right or wrong. However, for me, I like to structure it slightly differently. I like to structure mine, and just the reason why I did this is because back in 2007, 2008, I went through a period where I near enough was on the brink of bankruptcy. And I don't mind sharing that. It's actually all well documented in my book called Boom, Bust and Back Again, and you can find the link here below. It's available on Amazon, and it's an Amazon bestseller. And by the way, that's not a plug, that's just happened to be part of the story. So back in 2007, 2008, I owned quite a large development company, and off the back of that, as a result of recession, as a result of the market crashing, we saw that the development company was no longer viable, and we ended up becoming almost insolvent. However, prior to that, all my mortgages were all on interest only. And I found that a lot of my portfolio back then was in negative equity. I bought it well, but even I bought it 20% discount, and even as a result of the market dropping circa 30%, which is what it did in 2007, 2008, I was still in negative equity. So I changed my strategy dramatically. I had two options. I could have literally just handed the keys back to the lenders and said, guys, okay, enough's enough. I can't afford it. The portfolio is in negative equity. It's making some cash flow, but nothing that's going to really change my life. So here's the keys and off you go. Alternatively, the other thing that I did is that I changed it over to capital repayment. Now, the reason why I changed it over to capital repayment, and it's quite simple terminology when you look at it in this respect. I treat my properties now as almost like a piggy bank. Just imagine that every month I'm paying the interest, but I'm also paying a small amount towards the capital as well. So I'm knocking away a part of the debt. So if the property value was 100,000, I borrowed 75,000 initially, which is 75% loan to value. Every month I'm knocking away that 75,000, and the goal is at the end of the term of the mortgage, I should be completely debt free of that property. Now, one thing that I did do is that after 2007, 2008, I structured it so that all my debt now will be zero at the end of the term. So here, let's go to my second one now. So this is capital repayment. You can have a look at that. We've got the debt level there. You can see that the debt level is actually coming all the way down. It's coming all the way down. So when I took the mortgage out, it was here. When I end the mortgage, it should be pretty much zero. However, have a look at what happens in the market fluctuations. The market will fluctuate as it would do normally. Sometimes we'll get a boom, we'll get a bust, and we'll have a recession period. At the moment we're going into recession, and so no one knows what's going to happen with the value. However, regardless of what happens, I'm still in a win-win situation. The reason why I'm in a win-win situation, very simple, because my debt level is coming down. So even if I sold it, circa around here, if I sell it here, I'd be absolutely crazy because I'm actually losing money still. However, if I sell it even here, which is circa 50% of marketplace, I'm still winning. If I'm selling it here, I would be selling it at approximately, I would imagine, around 80% loss, which no one would ever do anyway. I would work on the basis that even at a 50% level, I'm still quids in, which means that if the market increases, I've naturally increased in capital value anyway. If it decreases, I'm still in equity. And the reason why I've done this is because, first of all, I don't want to be in the position that I was in 2007, 2008. More importantly, I become a lot more attractive to banks. So when I take out other lending on other deals, now I've got other deals going through, I've got a piece of land going through that we're potentially going to get planning on for circa 30 odd apartments. We're not intending on building, just purely because of my experience of building. Some could say that I'm quite scarred from that. One of the things that we'll do, we'll get the planning on the site, and we'll potentially just dispose of the site with the new planning game. So there's lots of things that we do with property. But the good thing is that with my portfolio, I know that I never have to worry about that again. The debt level is always decreasing, and if the property prices increase, yes, I've benefited not only from the equity that I've bought into the property, shall we say, the property that I've chipped away at all throughout the period, but also any potential growth. Now, there are positives and negatives. I've just told you about the massive positive. One of the negatives is the tax is that when I come to sell the property, because there's no gearing on the property, then I will get hit quite well with the tax. However, if you plan this structurally, if you structure your tax sufficiently and you do it well in advance and you speak to a property tax specialist, there are ways that you can get around. When I say get around, I don't say get around as in a legal way. There are things that you can utilise where you've got your children and you can transfer properties to children, and providing that they hold it for a certain period of time, that they don't pay inheritance tax. And this is all legal by HMRC, by the way. So I don't condone anything that's not, or I don't condone tax avoidance. I always work within the guidance of HMRC, and I've got very good advisors that provide me with that advice. So the one thing that I don't go into any of these schemes or anything like that, because I find that they will come back, and they are all literally just loopholes, and eventually HMRC closes the loopholes and you're back to square one. That's a little tip from me. And I've not experienced that, but I've gone through this many times with lots of people who say that they can save me money. They might save me money short term, but long term, you have to think of what the risks are. And if you think about that in you see lots of people, lots of celebrities have been caught out on tax scams, or where people said that they can save tax. Don't go down that road. And I don't know even how I got onto that topic, by the way. So when I get down to this point, 2025, I've structured it to a point where all my debt will be zero. Now, I've actually structured my debt so that on the 11th of November 2025 at 11:59 p.m, I become completely debt-free. And the reason why I've done that is because on the 12th of November, I actually turned 45, which means that on the 12th of November, when I wake up, all my debt is zero, all my properties would have been transferred to my daughters, I've got no inheritance tax issues, they've now got a portfolio which is completely debt-free, and it works extremely well. I've structured it, back from 2008. And this is what you guys should be looking at. So when we're looking at, is it interest only? Now, for me, interest only is you're gambling. You're gambling because you don't know what the market is, and more importantly, you don't know what's going to happen with your property price. Your debt level will remain the same, which means that in essence, I don't know, I shouldn't say this, because it's pretty much like the same as renting. You're paying money and you're only paying the interest. You're hopefully going to get some capital appreciation, and I use the word hopefully, because there's no guarantee that it's going to get capital appreciation. The property market fluctuates. We've seen it. We're in it right now. For those that bought the properties in the last couple of years, you may slightly be worried that your property may be in negative equity, but that's what happens in property. But remember, you're not investing for 6 months. You're not investing for 2 years. Hopefully, when you take a property out or a mortgage out, you're investing for the next 10, 15 or 20 years. So this is the way that I look at it. I look at it from a longer term view. I structure my debt on a longer term view. Now, one last little tip that I'll give you is that when I structure my debt, I try and fix the loan as long as possible. So that 25-year plan that I had, I structured the debt on a fixed term, not only for 2, 3 or 5 years. I structured the debt for a long period. Now, I appreciate that we've got lots of things that have happened to us. We're at the lowest point. We've had the lowest interest rate that we've ever had. There's even talks of it being going into a negative interest rate, but I've structured my debt at around 3 to 4% throughout the whole period. Now, you may think that that's crazy because I may have benefited slightly from a lower interest rate. However, I've got the certainty of knowing what's going to go on in my portfolio for the next 20, 25 years. Regardless whether the interest rates go to 6%, it doesn't affect me because I'm still at 3 to 4%. If it goes down to 2% or 1%, etc., then slightly I may be paying slightly more, but my cash flow remains static. My cash flow isn't doing this every month. My cash flow remains static. So I like to sleep at night knowing what my portfolio is doing. I'll talk to you about other videos and HMOs and how I've structured my HMOs in a very similar manner. So guys, hopefully you've enjoyed the video. Hopefully you've taken a lot away from it. Hopefully you've enjoyed my hand drawing, which you can see is actually done on scrap paper. But that's the way it is. It's very simple, guys. If you think about it and you look at it in a logical manner, look at your portfolio, stress test your portfolio and see where do you want to be over the next 5, 10, 15 and even 20 years. As always, if you liked the content, please press subscribe or press the notification bell. If you want to catch up with me on social media, you can catch me on Facebook, LinkedIn, Twitter and Instagram. Finally, if you're looking for property deals still, have you downloaded the Property Investor app? The reason why I say that is because I've created the UK's first property investment platform. It's called Property Investor. You can go to www.propertyinvestorapp.co.uk, or you can literally, if you've got a smartphone, you've got an Apple phone, you've got an Android phone, literally go to the App Store and type in Property Investor. It's a little blue house with a key in the middle. Download it. It takes 2 minutes to register, and you'll see all the deals all over the UK. We've got rent-to-rent deals, we've got lease option deals, we've got development deals, we've got below market value deals. Some of the deals are circa 30 to 40% below market value. I should just finally mention that if you want some more free information and some free education like this, I've actually got a podcast which we release every Tuesday. It's called The Property Rebel. So all you've got to do is that you can go to the podcasts, so Apple Podcasts, and type in Property Rebel. You can find this on Stitcher. You can also find this on Spotify, as well as SoundCloud and Google Podcasts. On that note, guys, I hope you found the video of great value, and I look forward to speaking to you all very soon. Bye-bye.